On March 12, 2012, a message arrived at the headquarters of SWIFT, the Society for Worldwide Interbank Financial Telecommunication, in La Haye, Belgium. The message came from the European Union. It instructed SWIFT to disconnect all Iranian financial institutions from its network, effective immediately. No warning had been given to Iranian banks, no grace period was offered. The disconnection happened overnight. And the following morning, Iran's ability to conduct international financial transactions, to receive payment for its oil, to pay for its imports, to transfer money across borders in any currency, effectively ceased to exist. It was the most powerful non-military economic strike in modern history. And it was delivered not by a missile, not by a naval blockade, but by a Belgian cooperative society that most people had never heard of. Understanding what happened to Iran in 2012 and what happened to Russia in 2022 requires first understanding what SWIFT actually is. SWIFT is not a bank. It does not hold money. It does not process payments directly. It is a messaging network, a secure, standardized communications infrastructure that allows financial institutions in over 200 countries and territories to send each other verified, authenticated instructions about financial transactions. When a company in Germany pays a supplier in South Korea, the German bank does not wire money directly to the Korean bank. It sends a SWIFT message to the Korean bank's correspondent bank, instructing it to release funds. The correspondent bank sends another SWIFT message confirming receipt. The money moves through the relationships between institutions. SWIFT is the language they use to talk to each other. This may sound like plumbing, but SWIFT's position in global finance is more analogous to the internet itself than to a single website. It carries approximately 42 million financial messages per day. It connects more than 11,000 financial institutions in over 200 countries. Every major international payment, every cross-border trade transaction, every foreign currency settlement, every sovereign debt payment runs through it or depends on institutions that do. When SWIFT disconnects a country's banks, that country does not merely face inconvenience. It faces the financial equivalent of being cut off from the global telephone network. What makes SWIFT exclusion so devastating is that it does not operate in isolation. SWIFT disconnection triggers a cascade through the correspondent banking system that is in many respects more damaging than the disconnection itself. Correspondent banking is the network of relationships through which banks in one country hold accounts at banks in another, allowing cross-border payments to flow even when the two institutions have no direct relationship. Major financial centers, New York, London, Frankfurt, Tokyo, serve as hubs in this network, with large institutions like JP Morgan, Citigroup, and Deutsche Bank maintaining correspondent relationships with thousands of banks worldwide. When a country's banks lose SWIFT access, correspondent banks in New York and London become unable to process instructions from those institutions, and more importantly, they face US sanctions liability if they continue to transact with excluded entities. The result is that even banks in non-sanctioning countries quietly sever correspondent relationships with excluded institutions to protect their own access to the dollar clearing system. SWIFT exclusion, in practice, means dollar exclusion. And dollar exclusion means near total isolation from international trade finance. The Iran disconnection of 2012 was the first time SWIFT was deployed as a geopolitical weapon at this scale. The effects were severe and immediate. Iran lost approximately $30 billion in annual oil export revenues within the first year. Its currency, the rial, lost more than 70% of its value within months. Inflation surged. Import costs exploded. The Iranian government, which had structured its entire public finance model around oil revenues denominated in dollars and euros, found itself unable to receive payment for the commodity that constituted the majority of its income. The SWIFT exclusion did not ultimately force Iran to abandon its nuclear program, but it demonstrated, beyond any reasonable doubt, that financial network exclusion was a weapon capable of causing economic damage comparable to, and in some respects exceeding, conventional military pressure. That demonstration was noted carefully in Moscow, and when Russia invaded Ukraine on February 24, 2022, and Western governments began assembling a sanctions package, the question in every major capital was not whether SWIFT exclusion would be part of it. The question was how far it would go. The answer was partially. Facing intense pressure from European governments, particularly Germany and Italy, whose energy sectors were heavily dependent on Russian gas payments that flowed through SWIFT-connected banks, the European Union and United States agreed to disconnect 7 Russian banks from SWIFT, rather than the entire Russian financial system. Sberbank, Russia's largest bank by assets, was initially exempted. Gazprom Bank, through which European gas payments were routed, was explicitly protected. The exclusion was targeted, not total. This partial application of the weapon had 2 consequences that its architects had not fully anticipated. First, it did not produce the financial collapse that a total disconnection might have caused. Russia's economy contracted sharply in 2022 but did not implode. Ruble settlements, alternative payment channels, and the continuing flow of energy revenues through preserved channels, including critically the Gazprom Bank exemption, kept the Russian financial system functioning. Second, it revealed to every government in the world that SWIFT access was conditional on Western geopolitical approval, and that demonstration accelerated a process that had already been underway for years, the construction of SWIFT alternatives. Russia had been building its own financial messaging system since 2014, when the threat of SWIFT exclusion first emerged following the annexation of Crimea. The system for transfer of financial messages, known by its Russian acronym SPFS, was initially designed as a domestic backup, allowing Russian banks to communicate with each other through a state-controlled network that did not depend on SWIFT's Belgian infrastructure. By 2022, SPFS had grown to connect roughly 500 Russian financial institutions and had begun expanding internationally, with connections to banks in Belarus, Armenia, Kazakhstan, and several other post-Soviet states. It is not a global substitute for SWIFT. It carries a fraction of the message volume and operates in a limited number of currencies, but it provided Russia with a functioning alternative for intra-Commonwealth payments that did not require Western permission. China had been running a parallel project since 2015. The Cross-Border Interbank Payment System (CBIS) was designed from its inception not merely as a SWIFT backup but as an alternative architecture for global payments denominated in Chinese yuan. CBIS has 2 components, a messaging layer that mirrors SWIFT's communication functions and a clearing layer that settles transactions directly in renminbi. By 2023, CBIS had connected over 1,300 financial institutions in more than 100 countries. Yuan-denominated cross-border transactions processed through CBIS had grown to trillions of yuan annually. It is not yet large enough to threaten SWIFT's dominance. But it is large enough to matter, particularly for transactions between China and countries seeking to conduct trade outside dollar and euro infrastructure. The project that most directly challenges SWIFT's long-term position is one that received relatively little attention outside specialist financial circles until 2024, mBridge. The multiple central bank digital currency bridge was originally developed by the Bank for International Settlements, the so-called Central Bank of Central Banks, in collaboration with the central banks of China, Hong Kong, the UAE and Thailand. Its concept is straightforward and radical. Rather than routing payments through SWIFT's messaging network and correspondent banks, mBridge allows central banks to conduct wholesale cross-border payments directly in their own digital currencies, with no correspondent bank intermediary and no SWIFT message required. Saudi Arabia joined the project as a full member in 2024. The BIS quietly withdrew from active participation in mid-2024, citing concerns about the project's compatibility with international standards, a move widely interpreted as Western pressure on an institution it nominally controls. What mBridge represents, in the assessment of economists who study financial infrastructure, is the first technically credible architecture for a parallel global payment system that could handle large-scale cross-border transactions without touching either SWIFT or the US dollar correspondent banking network. It is not operational at commercial scale. It may never be. The technical and regulatory challenges are immense. But the fact that it exists, that a group of major economies accounting for a significant share of global trade have built and tested a working prototype, is a signal that the SWIFT war has entered a new phase. The deeper irony of the SWIFT weapon is that its most powerful deployments may be accelerating the conditions that will eventually render it less powerful. Every time Washington or Brussels uses SWIFT access as leverage, every government in the world that is not a close Western ally draws the same conclusion. SWIFT access is not a neutral infrastructure right. It is a privilege granted by Western institutions and revocable at Western discretion. And governments that draw that conclusion have every incentive to invest in infrastructure that does not depend on that privilege. This is not a new observation. Economists who study monetary geopolitics have been making it for over a decade. The dollar's dominance as a global reserve currency depends in part on the absence of a credible alternative. SWIFT's dominance depends on the same condition. And the more aggressively the SWIFT weapon is deployed, the more urgently adversary and non-aligned states alike work to create that alternative. The exclusion of Iran accelerated China's development of CIPS. The partial exclusion of Russia accelerated the expansion of SPFS and gave mBridge political momentum it would not otherwise have had. The question that the SWIFT war ultimately poses, and that no Western government has publicly answered in any official forum, is this: at what point does a financial weapon become so frequently and broadly used that its very use accelerates the fragmentation of the infrastructure that makes it powerful in the first place? SWIFT works as a weapon today because there is no credible alternative for most of global trade and most cross-border financial settlement. Every SWIFT exclusion that happens without producing its intended political result, and every new alternative payment architecture that reaches operational capability, brings that day of diminished effectiveness measurably and incrementally closer than it was before. The SWIFT war is being won, tactically and in the short term, by the countries that control the network. It may be being lost strategically by the very act of fighting it.